Over 90% of crypto investors lose money. Why? In the rapidly evolving world of cryptocurrency, the allure of quick riches often blinds investors to the harsh realities of the market. A staggering statistic reveals that over 90% of crypto investors ultimately lose money. This sobering truth stems from a series of repeated mistakes that many make, often fueled by emotions rather than strategy. The thrill of the chase, the fear of missing out, FOMO, and the promise of exponential returns can lead even the most cautious individuals down a perilous path. One of the most common pitfalls is FOMO buying at market peaks. Investors, swept up in the excitement of a surging coin, often rush to buy in without considering the underlying fundamentals or market conditions. They see others making significant gains and fear being left behind, leading to impulsive decisions that can result in devastating losses when the market inevitably corrects itself. This emotional buying often occurs just before a downturn, leaving investors holding assets that plummet in value almost immediately after their purchase. Another significant challenge is the lack of a clear entry or exit strategy. Many investors dive into the market without a well-defined plan, which is akin to sailing without a map. They buy coins based on hype or trends, but fail to establish when to sell, often clinging to their investments in the hope that prices will rebound. This can lead to a cycle of loss, as they watch their assets diminish in value, only to sell at a loss out of desperation. A well-thought-out strategy is essential for navigating the volatile waters of crypto investing. Chasing trending coins is yet another mistake that frequently leads to financial ruin. Investors often jump from one hot coin to another, driven by the latest news or social media buzz. This creates a portfolio that lacks coherence and is heavily influenced by short-term trends rather than long-term potential. Instead of focusing on solid projects with real utility, many find themselves holding a collection of coins that may not stand the test of time. The fleeting nature of trends can leave investors vulnerable to sudden drops in value, resulting in significant losses. Going all in on a single investment is a gamble that many take, believing they've found the next big thing. This approach disregards the fundamental principle of diversification, which is critical in managing risk. By putting all their capital into one asset, investors expose themselves to the full brunt of its volatility. If the investment doesn't pan out, the consequences can be catastrophic, wiping out savings and leaving them with little recourse. The crypto market is notoriously unpredictable, and a single misstep can lead to financial ruin. Neglecting risk management is perhaps the most severe error of all. Many investors enter the crypto space with a sense of invincibility, believing that they can weather any storm. However, the reality is starkly different. Without proper risk management strategies, even the most promising investments can lead to devastating losses. This includes failing to set stop-loss orders, ignoring market trends, and not maintaining a cash reserve for emergencies. Risk management is not just a safety net. It is a critical component of a successful investment strategy. To thrive in the crypto landscape, investors must adopt effective capital management strategies that not only protect their investments, but also position them for long-term success. The first rule of thumb is to only invest what one can afford to lose. This principle ensures that even in the worst-case scenario, individuals will not find themselves in dire financial straits. It's essential to approach crypto investing with caution, recognizing that the potential for loss is as real as the potential for gain. Diversification is another crucial strategy. Investors should consider allocating their capital across a range of assets, including top coins, mid-cap projects, and higher-risk plays. This approach mitigates the impact of any single investment's poor performance on the overall portfolio. By spreading risk, investors can better weather market fluctuations and capitalize on various opportunities as they arise. Maintaining cash reserves for market dips is a strategy that savvy investors employ to their advantage. The crypto market is notorious for its volatility, and having liquid assets allows investors to take advantage of lower prices during market corrections. This approach not only provides a buffer during downturns, but also enables investors to buy into promising projects at a discount. A measured approach to buying and selling is vital for successful investing. Instead of attempting to time the market perfectly, which is nearly impossible, investors should consider implementing dollar-cost averaging. This strategy involves investing a fixed amount at regular intervals, regardless of market conditions. This method reduces the impact of volatility and encourages a disciplined investing habit, allowing investors to accumulate assets over time without the stress of trying to predict market movements. Research is another cornerstone of effective investing. Investors should conduct thorough due diligence before committing capital to any project. Understanding the technology, team, and market potential of a coin can provide invaluable insights that help inform investment decisions. Additionally, securing long-term holdings with cold wallets protects assets from hacks and theft, ensuring that investments remain safe for the long haul. Ultimately, treating a crypto portfolio like a business can significantly improve an investor's chances of success. This involves keeping track of investments, analyzing performance, and adjusting strategies based on market conditions. Consistent, methodical investing is far more effective than sporadic attempts to hit big wins. By focusing on long-term success rather than short-term gains, investors can build a sustainable portfolio that withstands the test of time. In conclusion, while the crypto market presents both opportunities and pitfalls, it is essential for investors to avoid common mistakes, manage risk wisely, and adhere to a solid investment plan. By sharing their own investment rules and insights, individuals can foster a community of informed investors who navigate the crypto world with caution and strategy. Staying informed and maintaining a cautious approach to investments will not only protect capital, but also pave the way for long-term success in this competitive landscape. What's your #1 rule when investing in crypto? Let me know in the comments. And if this video helped you, don't forget to like, subscribe, and share it with a friend who's new to crypto. Stay smart. Stay safe. Stay in the game.